Welcome all to the Node. I am Mike, aka Veteran Crypto, and this is your place for news, interviews, and DeFi education, as well as crypto. Joining me shortly will be David, but until then, I will start jumping into it. So, got some exciting news. This coming Tuesday, it looks like that we're going to have a interview with a Canton project called Alpin. So pretty excited about that. Going to have the CEO on. So if you want to tune in for that, again, that's this coming Tuesday. So what, 6 days away, something like that. But we'd like to find interesting projects, and whenever we bring interviews, whenever we bring you interviews, we try to make sure that it's a solid, interesting project, and not just an interview. And we want to make sure that we're bringing quality. But
quality,
quality,
high quality.
Yes, exactly. So, and we got some other interesting news. So, Crux of Crypto, he's been on the show before, reached out to us, and he has a game show. Those that have been in crypto for a while might remember Around the Blockchain, and it's a similar show. And I got some video of the last episode pulled up for David and all of you to take a look at. But they've invited us to come on and be a regular on the show. So either myself or David, will be on the show, from time to time. And it's basically just a civil discourse. It's kind of what we've been trying to encourage here, where we want opposing views that can have well-reasoned, logic, data-based arguments about about these projects, about these tokens, about these projects, and be able to present a case for if we're bullish on it, or bearish on it. So, yeah, I'm pretty excited about it. But wait, what are you thinking, David?
I'm looking forward to it. I think it's going to be a great debate. We're going to be able to talk about all these different protocols, projects, coins, tokens, chains, what have you. It's going to be a really good time, especially when we get a different opinion, because look, I mean, we can perform all the deep dive research in the world that we want, but we don't have crystal balls, might have steel balls,
I got big steel balls.
Yeah, but we don't have a crystal ball. No one does. No one can predict the future. So it's going to be really valuable, I think, to have people who have a difference of opinion on that show with us. So I'm really looking forward to it.
No, absolutely. Well, it's really quick. Actually, let's bring it up and we'll discuss a little bit of it. So it's interesting. I would have loved to have been on this one. So Scott, he's been on the show here as well. Longview Compute, and he's a big Canton bull, and he is very knowledgeable about Canton and very knowledgeable about XRP. So I was very interested to see his take on this question. So it was later on in the show, almost at the end, because he wasn't able to make it till the end. But the question was, will XRP crush Canton? and I know our stance, but let's hear what some of these people have to say.
In the next bull market.
Oh, strongly disagree.
I strongly disagree. All right, so this one, Max, you got it out for you, brother. You're the only one that strongly agrees. We got Doc, we got Focus, and we got Scott. They're just ready to jump you. Get the little punches in real quick. Max, defend XRP with all your might. Let's get it.
Okay. Well, welcome, Scott. Glad to see that everything's okay.
Yes, everything's great.
All right. So you missed this. I'm going to go back to this. I don't know if you're aware of some of these things, but people point out, hey, I'm so sick and tired of XRP and the old documents and the old citations from Swift and how they tested the silence years ago. I point out the recent documents, and I've done a lot of hard work in regard to that. Bank for International Settlements document came out in May called Elasticity of Money, mentions, quote, ripple effects, and it points out specifically, I know you don't like speculation, but points out specifically the need for liquidity on demand.
What I think is funny is I was cracking up when I was first watching this because I'm watching Scott's face.
I know. He looks like he's in pain.
No, well, it's you can tell that it's like amusement and biting his tongue at the same time.
Yeah, like disbelief almost.
Yeah.
Man, what is Ripple's main product? On-demand liquidity. And last I checked, since all of us in unison do mention Bitcoin, guess what? One central bank, one, can move more money in one day than Bitcoin can move in an entire year. So
I can debunk that whole thesis because XRP, even if Ripple becomes the world, rails for cross-border payments, is big if. What role does XRP play in that?
Zero.
It's not the vehicle for liquidity. I mean, it still is use cases for it, to do that. Specifically for what is it? Non-dollar denominated assets. But most bank transfers are done in dollars. It's the world reserve currency. And RLUSD handles that. So in those cases, the only thing XRP is used for is gas, a very cheap gas token. And we've done the math here, and at max, transactions per second, running 24/7, 365, it would take over 5,000 years for just 10% of the supply of XRP to get burned.
But Mike, you're talking facts, man. We don't need to worry about facts when we're talking about XRP, man. It's all about feels.
It's this same tired narrative that, because this is all stuff I heard when I got into crypto like 5-6 years ago. All of these, that XRP is going to be the cross-border payments and all this. And then he, goes on to talk about Ripple Prime, with the DTCC. Because Canton Network, those that don't know, they soft launched for the DTCC for tokenized assets, and XRP or Ripple and all that isn't a part of it. Other than they are the key custodian. Ripple Prime is the key custodian for the DTCC, which in no way involves XRPL or XRP. So that's not bullish news for XRP. But this Max guy is going to go on to state that it was in the documents, and that they're using Ripple Prime like it's bullish for XRP in some way.
Yeah, so when Scott was on our show, he said a couple of things that I found to be really interesting. Scott said that in 2025 there was $100 billion in cross-border payments settled using Ripple ODL. But only 5 billion of that was actually on the XRP ledger. So it seems to me like, okay, maybe, Ripple has a software product that is being used, that ODL, that Ripple Prime. Okay, great. Why does that matter to you if you hold XRP? There's no value accrual mechanism for XRP, the token. So if you're holding XRP, is there any value accrual mechanism for that 100 billion in ODL? I don't think so. And also, last year, because Ripple is a private company, you don't really have a window into their revenues, but you can guesstimate. And Ripple's revenues last year, I think it was like $200 million for Prime and ODL, which is not nothing. But they likely generated 10 times more revenue than that by dumping XRP. So, what's their actual business model? Is it, cross-border payments?
Their profitability is dumping XRP monthly.
Yeah, exactly. So
that's how they bought Medico. That's how they bought all these companies. Like the Max guy will go on to talk about one of the companies that Ripple bought that basically led to being Ripple Prime, that is making it part of the DTCC. All of those acquisitions were done, in the court case. The hundreds of millions of dollars that went to fight the SEC was all generated by selling XRP on retail.
So, I've got a little bit of information here about that key custodian statement that you made earlier, Mike, because I've heard that all over the place on X and on socials about, Ripple being the key custodian for the DTCC. And according to Gemini, okay, so just I want to caveat this by saying this is according to Google Gemini.
Yeah.
So according to Gemini, Ripple Prime is not the custodian for the DTCC, but rather is an approved clearing participant on DTCC clearing rails and a member of its institutional tokenization initiative. So according to Gemini, social media hype often twists this relationship. So understanding how the Depository Trust and Clearing Corporation and Ripple Prime actually fit together, that helps to clarify this distinction. Because whenever I hear that Ripple is a key custodian for DTCC, I always think, I'm going to call bullshit on that. But I see that all over socials. So yeah, there's a difference between being a key custodian. I don't think that that's what they actually are. So it looks like Ripple Prime is a clearing participant with that Hidden Road acquisition. So when Ripple acquired institutional prime broker Hidden Road, that was rebranded under Ripple's institutional offerings as Ripple Prime. So Hidden Road was added to the participant directory of the National Securities Clearing Corporation, NSCC, a primary clearing subsidiary of the DTCC. That gives Ripple Prime direct access to DTCC's clearing and settlement rails, letting them clear traditional and digital trades alongside Wall Street incumbents. So Ripple Prime joined the DTCC's industry tokenization group alongside over 50 major global financial institutions, including the likes of BlackRock, JP Morgan Chase, Goldman Sachs, etc. So this group is establishing institutional standards for moving equities, treasuries, and ETFs onto digital rails, onto blockchain technology. But that doesn't make them like the key custodian. So I just want to drill down into exactly what it is that Ripple Labs' role is as like a key custodian, because it just does not make sense to me that the DTCC was selected.
I'm trying to find where I read that, because I could have swore that that wasn't something I learned on socials. That's something I actually went and read when I was like digging deeper, because when people make claims like that, I like to go and actually find out from primary sources. So keep going. I'm going to see if I can find where I found that.
Yeah, so I mean, the way that I think about it is this way. If Canton Network is clearing all of this repo volume, why would that have anything to do with Ripple? I don't think it does. I think it has zero to do with Ripple. So what is Ripple custody? So it looks like a key custodian.
Well, Ripple Prime and a lot of Ripple's offerings have nothing to do with the XRPL or XRP. It's right. So that's something that people really need to understand, is that just because there's bullish news about Ripple does not mean that translates to price go up for XRP. Other than ignorance, other than people seeing Ripple's name, seeing something bullish going on and rushing out to buy. And again, you never said you can't make money with XRP. You can trade speculation. You can trade the buy the rumor, sell the news, and all that stuff. What we're saying is that for a long-term investment, you need to understand these tokens at a deep level to understand if they have value capture. Because if they don't have value capture long-term, you're playing a dangerous game. If you're just going to buy a token and sit on it and not pay attention to what's going on in these markets, there's a good chance that you're going to end up losing your money.
So I've got some more information about this key custodian thing. So, in the digital asset space, being a, quote, key custodian refers directly to private key management. So this is the cryptographic authorization required to hold, transfer, and importantly, sign transactions for tokenized assets on a blockchain. So because owning the private keys equals owning the underlying assets, institutional custody is fundamentally about key security. So Ripple's role as a digital asset key custodian centers on its enterprise platform, Ripple Custody. So that's built largely around its acquisition of the Swiss institutional custody provider Medico. So what Ripple Custody actually does is that rather than operating like a traditional consumer wallet or exchange, Ripple provides bank-grade key management infrastructure to major financial institutions. But I don't think that has anything to do with, Canton or, the other digital asset rails that are
I must
being.
have fucking hallucinated.
No, because Mike, I've heard that. I've heard that all over the place, man. I haven't just heard it from you. I've seen that on socials
and
too.
I apologize. I keep on saying that, with confidence, and I cannot find it anywhere. So until I can find, that, cited source.
But this is just another example of a claim that's made by XRP and Ripple people that's just patently false, man. Like a key custodian for the DTCC, like, nah, not true. They custody keys on Ripple Prime. Well, yeah, duh.
It was even worse. I was trying to give credit, credit, to where there was something, but for the most part, all it is that Ripple can use the rails that the DTCC is building, and they are on the advisory board. That's it.
Yeah, I think it's a big nothing burger. I think that the DTCC right now is just, they're trying out a bunch of different chains. And I think they're going to go with the best one. And as of right now, the best one is not Ripple Prime ODL. The best one is Canton Network as of right now.
I almost fell out of my chair watching these guys. One of the guys said, the dot guy, and he's not a huge XRP bull. He's he's actually, on this question leans more towards Canton, but he made a statement that stable coins earlier in the show, that stable coins were going to be a huge narrative, which I agree. But
they already are.
Well, yeah, but he made a comment that that there was, what was his exact? I actually quoted him in the comments, that there was a ton of stable coins on XRP, and I almost fell out of my chair. I'm like, where? There's $1 billion, and the majority of it is RLUSD. So it's.
I think that's all it is.
There's a touch. I looked up on DeFi Llama. There's a little bit of USDC and a bunch of other stable coins that I've never heard of, but I was just like, in my mind, I'm like, if you want to talk about chains and stable coins, Tron. Tron is what immediately comes to mind. Do you mind taking over for a second?
Sure. So Crypto Stevo, in the chat, you're saying the winners of this cycle are so obvious. And, let's talk here about hype for just a second, because, hype with the hype token, Hyperliquid, the perpetual futures DEX, with that hype token, I want to talk about something called stars. Okay. So I don't know if you guys have seen this at all yet, but I just want to look this up on X real quick. Hyperliquid stars and the Clarity Act. So, I've been talking a lot recently about how I think the Clarity Act is going to be a huge net negative. I do not think that the Clarity Act is a net positive in any way, shape, or form. I think that what we've seen with the Genius Act so far is that it's written by banks, and it was not written to benefit retail. Like you and I and everyone else on this call, like we don't benefit from being unable to earn yield on our holdings of USDC, USDT, or any other payment stablecoins. So, that tells me that we don't have people in Congress who work for us, retail. They work for the people who pay their bills and get them elected. That's the banks, okay? So I'm thinking to myself that this Clarity Act is going to be a huge net negative. I think what it's going to end up doing is it's going to give clarity for the government into what assets you hold, where you hold them, and where they can go to steal from you. And so I think that for Hyperliquid's got a big problem here, because Hyperliquid is an American company. And so what's going to happen when that Clarity Act, or if the Clarity Act isn't voted on and passed at some point in the future, what's going to happen when the SEC puts together some rules that say, hey, we need to know who holds what assets where? And Hyperliquid, if you've got Americans trading on Hyperliquid, you got to get them to pass KYC AML, otherwise they can't trade. Because I saw something on X last night where a large trader, a guy with 7 figures on Hyperliquid, that his account was essentially frozen. Because if you can't sign transactions, if you can't trade, but you've got assets on Hyperliquid and they're frozen, you're stuck. So I think what's going to happen here with Hyperliquid is they're going to comply with whatever the Clarity Act language is. They're going to comply with whatever the SEC says they have to. And that will mean that if Americans aren't allowed to trade on Hyperliquid, then you could just get stuck. Your assets could get stuck there. And that's what happened to one trader who I was reading about last night. It's in my bookmarks. I can go ahead and find it. But here, let's this is not good, man. So the silent, let's see here. I think that I can find this, man. It's called stars. That's what it's called. It's called stars. And it's like something that's been, built in to Hyperliquid, to HIP3 markets, where DEX operators of an HIP3 market on Hyperliquid, they can build in an allow list. And so what that means is if you're not on the allow list, you're not whitelisted to be able to trade in that market because maybe you're an American citizen, maybe you didn't pass KYC, then if you've got assets on that market, you're essentially frozen, locked out. That means you can't move them. So even if you turn on a VPN, if you can't access the Hyperliquid front end and you can't access the Hyperliquid API, but you've got assets on Hypercore, you're stuck, man. So I've been thinking, after I read that last night, Mike, because I was already thinking that this Clarity Act is going to be a huge net negative for retail in the United States anyway. And after I read that about one trader getting essentially locked out of his own account, I was thinking to myself, man, I got to get my assets off of Hyperliquid, dude, because the moment that they are forced to comply with this new legalese and the Clarity Act or whatever the SEC says, I think that people are not going to be able to trade on Hyperliquid, American citizens anyway.
Crypto Steve-O brings up KuCoin, and I was using KuCoin. It was actually my favorite place because I was actually earning yield. Basically just kind of staking. They had all kinds of staking and all kind stuff like that to where you could earn yield. And I made some good money doing that. But they started doing the KYC AML thing. And so I had to stop using it, and I think that's, for these platforms, if they want to comply and, they want to be, used by institutions and they want to be used by big money, they're going to fall into line.
So something that Crypto Steve-O just said here, I don't think Clarity will pass. So this all might be a moot point. Well, even if the Clarity Act isn't voted on, doesn't pass this year, I don't think that's going to matter because the SEC chair, he just came out recently, I think it was yesterday, and said that, hey, even if Clarity doesn't get voted on, doesn't pass, we're still going to create our own rules. So even if it's not signed into law, the SEC could, just by passing a rule, force American DeFi protocols to comply with that rule. So, yeah, man, I think that the Clarity Act is going to be a huge net negative, says retail.
And the fact that it's a rule, after the midterms and then, the presidential election in 2 years, if it's just a rule, it can get changed by whoever, gets put into, power at the SEC. I mean, we saw that with Gary Gensler. He was just making up rules as he went. And then as soon as, he was out and the new guy was in, they did away with a bunch of those rules, made a bunch of new rules. And if something isn't an actual law, it just matters who's in power. These institutions, that's why they haven't moved in mass yet when it comes to their liquidity, is because, they're waiting for clear rules and regulations because they don't want to deploy, billions or trillions of dollars of liquidity. And, come to find out, on the drop of a hat, that, somebody has a bad day, their wife cheats on them or something like that. And they come to work and decide to make a rule that, wipes out a good portion of their assets under management. That's just not something that they're going to do.
So, Mike, I think what's going to happen with this Clarity Act is it's going to be a surveillance bill. I think that that's what this is going to be. I think it's just going to be probably the largest surveillance bill in U.S. history. I think it's going to end up being the mechanism by which you will own nothing, eat bugs, and be happy. Like, I think that's what's going to happen here, man.
Honestly, most legislation that gets passed, more recently is all about control. It's all about power. It's all about money. It's all about surveillance. I mean, we did an episode on those flock cameras. They're installing those flock cameras everywhere. Basically, we're becoming the UK, where on every street corner there's like 18 fucking cameras pointing 18 different directions. To where you can't do anything and not be monitored or tracked.
Okay, so the Clarity Act is going to counter, quote, illicit finance. All right. What the hell does that mean? Illicit finance? That means any activity that they can't tax you.
Control or monitor.
Right. So it's going to direct the Treasury to clarify and tailor BSA and sanctions obligations for digital asset intermediaries, surveillance. It's going to expand grants and training programs for federal, state, local, and tribal law enforcement to combat all forms of scams and illicit activity involving digital assets. Again, what does illicit activity mean in this context? I think it means anything that they can't monitor or surveil. It's going to impose robust anti-fraud measures on digital asset kiosk operators. So that's just simply going to mean you're no longer going to be able to buy Bitcoin or ETH or stables at one of those, Bitcoin ATMs without, like proving, hey, here's my blood type, here's my mother's maiden name, here's my social, here's like 5 forms of ID. Like, this is all about surveillance, man.
Well, let's jump into some other news. But found this interesting. Braille launches ION, interoperability protocol to solve the stablecoin industry's liquidity problem. So Braille today announced ION protocol enabling DeFi mint burn routes across the most diverse group of stablecoins in the world. Braille's new protocol eradicates the liquidity funding obligations for bespoke stablecoins in liquidity pools. Partners at launch include Solana, Monad, Rain, CoinFlow, Turnkey, Spark, and Canton, with more to come. ION protocol removes a multi-billion-dollar hurdle for stablecoin adoption. Today, moving assets across blockchains typically depends on liquidity pools, which fragment capital and introduce slippage and bridge risk. As ecosystems scale, duplicating deep liquidity across every ecosystem becomes impossible, leading to a ceiling on stablecoin adoption. ION protocol removes these constraints. ION protocol uses an attested burn, attest mint model. Assets are burned on the source chain before an equivalent amount is minted on the destination chain with the issuer's authorization. This eliminates duplicate circulating assets, reduces custodial bridge risk, and maintains a single canonical source of truth across blockchain networks. It's all powered by Braille's technology, which has already enabled more than 10 billion in mint burn activity. What do you think about that, David?
Okay, so we first need to understand what is ION and Braille. So Braille is a U.S. regulated stablecoin issuance platform. It's designed to move custom fiat-backed stablecoins across different blockchains without using so-called pre-funded liquidity pools. The ION protocol is an interoperability protocol launched by Braille. So this ION protocol eliminates the need for these liquidity pools by using what you were just talking about, Mike, the native burn attest mint model. So there's a fundamental flaw with liquidity pools and liquidity provision. That fundamental flaw for LPs is that the volatility in those pools is lower than what it is external to the pool. And so what that means for LPs is you don't have a statistical edge when you provide liquidity. In fact, you're likely to lose money over time as an LP, especially now that we've seen Uniswap's fee switch. So that fee switch, man, we were talking about it in the community source room at the Node.pro earlier today. I think Dutch DeFi was talking about it. I think Paulo was talking about it. And I mean, look, man, like if you're providing liquidity on Uniswap v3 or v4 on any chain other than the base chain, as of just a couple of days ago, you now earn between 20 and 30% less in LP fees. So that's like all of your profit right there. So it no longer makes sense to provide liquidity.
More specifically, I mean, I want to get back to this article, but I mean, as far as this use case, and specifically just the what it means to address the issue of duplication. So the fact that this would potentially, if it works as advertised, would eliminate the need for bridges, which would eliminate a lot of risk in navigating and moving liquidity, and also the fact that it would burn like if you were moving stablecoins, if I was moving USDC from one chain to another, from like Base to Ethereum, or Base to Solana, we'll say, it would burn the the stable coin that I was sending before it allowed it to be minted on a Solana. So it sounds very interesting to me, but I'm interested on your take on, is this really necessary?
I mean, look, there are big problems with bridging and these bridge providers because they basically, these lock and mint bridges, traditional lock and mint bridges, hold these massive honeypots of locked assets, and that makes them a prime target for exploits. So this ION protocol, by burning tokens at the source, it eliminates this smart contract vault risk. So that's a big deal. That's a huge net positive. It also claims to eliminate slippage and impermanent loss because tokens are minted one for one, and they're minted one for one on demand rather than being swapped through a market maker, or if we're talking about liquidity pools, the market maker would be the liquidity pool. And that way transactions incur zero trade slippage, and it eradicates pre-funding obligations.
Wouldn't that be considered like an atomic swap? Or
no. So it wouldn't quite be, kind of, sort of. I think it's a very similar idea. Probably, same, but different.
Same, but different.
Right. Yeah. So same idea, though. Same type of idea. And also, if issuers no longer need to lock up millions of dollars in idle capital on multiple chains just to maintain bridge liquidity, then all of a sudden that capital can be used for something else, something more productive, maybe.
Yeah.
So, I mean, for businesses and fintechs that issue custom stablecoin products, expanding onto multiple blockchains, that creates severe liquidity fragmentation with the current liquidity pool model. So this would solve for that. So this is interesting, but I'm willing to bet that this is super centralized. So even though it would reduce bridge hack vulnerabilities, well, then you're just kind of shifting the risk from that honeypot bridge exploit to a centralized entity, an ION protocol. So yeah, man, I mean, look, you shift the risk and it doesn't eliminate the risk.
It just mitigates it.
Yeah, that's what it looks like to me. It looks like it does mitigate it. And Mike, in 90 minutes, actually in 86 minutes, we're going to get the Fed. No, the Fed.
Oh, Fed.
Yeah, it's a Fed day. So
I know there's some earnings reports that were coming out today and tomorrow.
Yes, so we're getting Meta and Microsoft today. So those are going to be big. Those are going to be big in market moving, and their CDSs have been blowing out, man. So, and all that means is the cost to insure a bond position has been increasing exponentially.
Gotcha.
Yep.
All right. Well, let's see what else we got here before we have you do some charts. So safe smart accounts hit record quarter. Account abstraction adoption continues its upward trajectory, with safe smart accounts recording nearly 130 million transactions in a record-breaking quarterly benchmark. So let's see what this is all about.
Yeah, safe is pretty cool. Gnosis safe.
Oh, actually, let's talk about. There's rumors that the Clarity Act is going to get a Senate vote before the recess.
I mean, great. Okay, like I don't think the Clarity Act is going to be a net positive, because let's say that it does get a Senate vote, and then President Trump signs it into law. Well, if all of these American, crypto and DeFi companies all of a sudden have to comply with Clarity Act regulations, and that means that in order to use these so-called decentralized protocols, you've got to pass KYC, or you're just locked out entirely as an American citizen. How is that a net positive again? Also, if you're a builder in crypto and DeFi, and the Clarity Act, regulates you into needing, 7 figures to comply with these regulations before you can actually build anything, how is that a net positive? Like, if you got to hire attorneys, to comply with these regulations before you can actually launch your product, I mean, is that a net positive? I don't know.
Just to be the kind of opposing voice, the contrarian. It would allow institutions, it would unleash their liquidity, and it would kind of untie their hands to build and launch and do all those things. So those of us that have been in crypto and that have positioned ourselves properly have the potential to profit greatly from that, if the assets that we hold have value capture, or if you're smart and you capitalize on the speculative pump, take profits, and don't get emotional and hold on too long, and lock in those profits. I can definitely see to where there could be an upside, but I definitely see your point where net that it could be quite bearish from a decentralized standpoint, from a libertarian standpoint. Absolutely.
Yeah, huge. I think it's going to be a huge net negative for the individual builder in crypto and DeFi, the individual developer who's got a laptop and an idea. You're no longer going to be able to build something for American citizens.
Innovation is going to take a big hit. I don't think that I can come up with a positive spin on that, we'll say.
Yeah. So I think it's going to be, I think the Clarity Act, everyone's like, oh, when Clarity Act passes, number go up. I don't think so, man. I think, I
can see a case for the markets going up, because, a lot of people will see it as a bullish catalyst. And again, a lot of these institutions and things like that, they're going to be a lot more able to participate in these markets. And so I see liquidity coming in that potentially could move the markets, quite nicely, but we'll see.
Yeah, I just don't see how that means, number go up for Bitcoin. Why would, more onerous regulations mean number go up for BTC?
I could just, not necessarily just BTC, the overall market. There's a lot of these institutions that are on the sidelines. They're testing out stuff. They're building. They're kind of at the starting line, stretching out, waiting for regulation and clarity, because legally, there's a lot of things that they can't do in these markets. With crypto, as far as investing, as far as building and things like that, without those regulations, without the clear rules of the road, that they're not allowed to do a lot of things. So I think with that clarity, I agree with you that it's going to be definitely a hit on innovation. It's definitely going to be a hit on decentralization. But when it comes to being able to profit, again, if you've done your research, if you've watched shows like ours that paint the whole picture, not just hype, and that focus on value capture, for the token, you might be positioned quite well for in your long-term investments, or if you're into a speculative asset that doesn't have value capture, but it has a strong narrative and it has a lot of hype behind it, and you're selling into that pump and locking in those some of those profits, then you could do quite well.
So I'm a bit of a contrarian here. And, I guess you could refer to me as a Cassandra. So in markets, a Cassandra is a contrarian. It's based on a myth from Greek mythology, right? So I'm just thinking to myself that, since everyone seems to think that number go up. If clarity gets passed, I think number go down. I think the Clarity Act ends up being an event where, number go down sharply.
Let me be more specific. I think market cap go up, but that doesn't necessarily mean price go up. I think that, market cap go up, and, it's because we've seen there's plenty of ways that these institutions buy these assets that don't affect the price. They do OTC and things like that they can buy these assets and not, pump the market. So, but, again, if your token has value capture, the one I like to use is Canton, with adoption, and if if these banks and institutions are moving liquidity and using projects like Canton Network to move RWAs, to move liquidity, and they're paying those fees, then that contributes to the burn, where that potentially could make the price of that token go up. So it doesn't it doesn't guarantee that all of crypto is going to go up. I honestly think that those past cycles of all what is that saying? The rising tide raises all ships. I feel like those days are coming to an end, and I think that last bull cycle we kind of saw that that there was very select narratives that pumped, and a lot of tokens didn't get a pump, and in this bear market have pulled back like 95% or more. And I don't know if a lot of them are even going to recover. I don't know if a lot of them are even going to come back.
No, I don't think so either. And I'm taking a look here at a couple of charts here, Mike. So I've got the NASDAQ brought up on my screen here, and this is starting to get to a level, getting closer anyway, to a level where you might think about nibbling on the long side. So we've got the 200-day moving average here and this level of horizontal support. So this is referred to as a confluence, when you have two pieces of information telling you the same thing. So if we zoom in just a little bit further, this is a daily. The NASDAQ has been correcting, likely because semiconductor stocks have really gotten shellacked. If we take a look at SMH, here's the semiconductor. This is the biggest semiconductor index. We had this parallel channel in which semis were rallying for months and months. When semis fell out of that channel to the downside, now they've almost entered free fall, and we've got that 200-day moving average quite a bit lower. So that 200-day moving average is going to be an important level of support. It's 12% lower. Now we've got to take a look at what the Kospi has done, because, and I was posting this in the community source room at the Node.pro earlier today.
Oh, did you factor in freaking Korea?
That's what I'm looking at here. This is the Kospi. This is that South Korean index. And, so dude, it's been limit down for the last
like 40% or 50% or some shit.
Yeah. So, I mean, from peak to the recent trough during the session today, it's down 44%. Now, you might think, oh my God, 44%. Well, yeah, but, if we just zoom out here a little ways and we take a look, there's that 200-day moving average, which failed today during the session earlier today for the Kospi. This is, again, the South Korean index. Now, if we just take a look at this over the last, I don't know, if we zoom out to, 18 months ago, from that trough to that recent peak, this thing rallied by greater than 300%. So to see a rally of 300%, to give back half of that, that's normal and healthy. The problem here is that a lot of South Korean traders and investors decided that it was a good idea to, buy on margin 3x levered ETF products. And it's like, okay, what did you expect was going to happen? If you use 3x leverage to buy a 3x levered ETF, so if you borrowed margin to then buy a 3x levered product, you should have expected this to happen. Markets don't just go up straight up forever. They eventually correct. So a 50% or so correction, that's normal and healthy. So, but this has been a big problem. If we take a look at the Nikkei also, this is the Japanese 225. This has corrected relatively sharply also. Now, these patterns, they look like semiconductor stocks. So the Nikkei is off 18% from its recent peak. And then if we take a look at some of the individual semis, American semis, here's Micron. Notice how similar the patterns for all of these assets look. So the Kospi, the Nikkei, Micron, SMH, all of these patterns look pretty similar because they're basically the same thing. They're all basically semis. So, the Micron here pulling back from its all-time high at 1260, pulling back by 40%. We take a look at SanDisk. SanDisk, man, was up at 2360. So if we just go ahead and measure from peak to trough, SanDisk is off by nearly 60%. We take a look at Western Digital. Western Digital is a very similar pattern. These are all semis. Western Digital from peak to trough off by nearly 50%. We take a look at Samsung. Samsung was up here at 6,000. And if we just measure from peak to trough, Samsung off by 40%. So, I don't have 5 decades of experience in markets, but the guys who I follow who have 4 or 5 decades of experience, what they say is that semiconductors have a cycle. And whenever you see a parabola out of semis and then a bunch of IPOs at the top, that tends to mark at least a medium-term top for stocks. So with the Kospi pulling back, with the Nikkei pulling back, with Micron, SanDisk, Western Digital, Samsung all pulling back, and then we take a look at the NASDAQ, the tech-heavy index pulling back also, so far this has been a relatively shallow pullback, only about 12 percentage points for the NASDAQ. But we take a look at the S&P, the S&P is holding support. So this level of trend line support that I've got drawn in on the S&P is, as of right now, holding support. It's going to be really interesting to see what happens when the Fed announces its rate decision here in about, 72 minutes. So in 72 minutes, we're going to get that Fed rate decision at 2 p.m. Eastern Standard Time. That is definitely going to be market moving. If I zoom in here to an hourly on the S&P, we did get a little bit of a break of that level of trend line support. So look, if I had to guess, I would say that we probably rally. Now, if we take a look here at something like Bitcoin getting rejected at its 200-period moving average on the hourly, let's zoom out to a daily. And let's see what we see here. So I continue to be a believer in the Bitcoin prophecy. That's just the Bitcoin market cycle. Whatever that Bitcoin cycle is, likely driven by the halving, I think that Bitcoin is likely to see more downside over the next 8 weeks into the beginning of October. My target for BTC is down here around 50K, let's call it. I'm going to start buying BTC at 51, 52. I think it gets down here over the next couple of weeks. If we take a look at Ethereum, Ethereum is actually outperforming Bitcoin and has been outperforming Bitcoin for the last couple of weeks. ETH is continuing to hold its level of respective trend line support. It's got a 200-day moving average all the way up here at 2120 for ETH. If we take a look at ETH in Bitcoin terms, now you can see that over the last several weeks, since the beginning of June, ETH has outperformed Bitcoin. Now, notice ETH in Bitcoin terms is holding above its 200-day moving average right here. And if we zoom out even further, we can see that, it's holding above its 200-day moving average, but it's sitting at a long-term level of trendline resistance. So here's that long-term level of trendline resistance. The anchor point here is all the way back at those 2017 highs for Ethereum in Bitcoin terms. I use that as the anchor point, drag down to the next lower high. That gives me trendline resistance. Notice that perfect touch during the Tom Lee pump of ETH back in August of 2025. And we're getting another push up towards resistance now. So my expectation here is that resistance holds and that ETH gets rejected one more time at resistance into the end of the Bitcoin bear market. So I'm thinking that ETH gets rejected here. We get one more push lower. That marks the end of the Bitcoin bear market, the end of the Ethereum bear market, and then we get the start of the next bull. But The thing for me, though, is, you got to continue to watch crude and interest rates, because there's always some type of crisis at the end of a Bitcoin bear. Last cycle, it was FTX collapsing. This cycle, it will be, hey, your guess is as good as mine. I don't have a crystal ball. If I had to guess, though, it would likely be something to do with either interest rates, crude oil, or that AI trade starting to unwind a little bit. So, we're going to get earnings from Meta and Microsoft later on this afternoon. So here is Meta. This is a weekly. And if I just go ahead and mark that 200-week moving average, it comes in down here at 478 for Meta. Now, Meta has borrowed heavily to get a bigger piece of that AI trade. If we take a look at Microsoft, Microsoft is exposed to OpenAI. And all that circular financing with NVIDIA, OpenAI, Anthropic, that is a problem. Because OpenAI and Anthropic, they're seeing their lunch start to get eaten by open source Chinese models. So if open source Chinese models are 90% cheaper and just as good as the models from these American frontier labs, how in the world is OpenAI and Anthropic, how are they going to be able to generate enough revenues to support those spending commitments? I don't think that they're going to be able to, man. So, Meta and Microsoft, these are going to be extremely important earnings events later on this afternoon when they report after the close, just after 4 p.m. Eastern Standard Time. I'm continuing to watch Oracle here, because it's starting to break down below this horizontal level of support that I've drawn in. It's below its 200-week moving average, and it's pulled back from its all-time high by, let's go ahead and measure this. This is a massive amount of capital destruction, by 67% from its all-time highs. So Oracle, another one of these big tech companies, big software names that has levered up significantly by borrowing to get a bigger piece of that AI trade. So far, not good. You take a look here at a name like SpaceX, where only 5% of the float is currently trading. And when SpaceX reports, which is going to be on Tuesday, August 4th, I think there's a massive unlock of shares on the date of their first earnings report. So when those shares unlock, what do you think someone's going to do who's been given options at $1? If that strike price is $1 and those shares unlock on that earnings report, and SpaceX is trading for $100, let's say $115 on earnings,
We're gonna sell the shit out of them.
Yeah, why would you not want to realize those gains on your option?
Yeah, 100x your freaking
You
investment.
got a 100-bagger, man. If you got a 100-bagger, you take those
In the
profits,
stock
right?
market, that's like freaking unheard. That's a unicorn.
Yeah, man. So SpaceX, basically down only after the IPO, and again, it's one of these companies where, is it going to perform well over time? I certainly think so. I believe in Elon Musk, but at the same time, dude, $20 billion in revenues last year. How in the world does that support a multiple trillion-dollar valuation? I don't think it does. Same thing's true for OpenAI and Anthropic. And you take a look at Tesla. Tesla, big breakdown here.
Shit.
Yeah, so this is Tesla. So this price action pattern, this is referred to as a gap and go. So gap down on earnings and go. Continuation to the downside.
That gap is a 45-year-old single mother there.
Hey, man, this thing right here, dude, gap down and go, and the breakdown of trendline support, trading well below that 200-day moving average after failing this little triangle, or this little, I guess you could call it a diamond pattern. So yeah, man, Tesla not looking too hot. And then if you take a look at NVIDIA losing its 200-day moving average on the session today. So here's that 200-day moving average. NVIDIA starting to fail at that 200-day moving average. So, NVIDIA is all roads lead to NVIDIA for this circular financing. And that's a problem. Like if I'm NVIDIA and I give you, Mike, $100 billion and you use that money to buy chips from me, dude, that's not organic earnings. So yeah, big problem here. And then if we take a look at Google, Googl, Google gapped down after reporting last week and is so far just working to fill that gap. Now, if I just go ahead and drag this down, you can see that gap. And let's just zoom in here a little ways so we can all see this a little bit more clearly. So there's the gap down, held support, lost that 200-day moving average just for 2 sessions, and starting to push back to the upside and fill that gap. Now, Google has levered its cash flows to be able to get a bigger piece of this AI trade, but they're not being rewarded for increasing their capex. So I think what investors are going to be looking for out of the Meta and Microsoft earnings later on this afternoon is, are they continuing to increase capex or not? If either Meta or Microsoft says on their earnings calls, hey, we're actually going to curtail our capex, I think they'll get rewarded for that. But we've got to take a look at yields here because we get the Fed in about an hour. So yields.
Quick, let's shift over, and Crypto Stevo had a question. He's asking if we can do him a favor. Go to DeFi Llama, click on Uniswap, look at the income statement for Uniswap, and give your thoughts on the earnings and the token holder net income. And he's wondering if those numbers look right.
Sure. So real quick, let's take a look at the Uni token. So the Uni token has rallied sharply from those lows at $2.35 all the way up to nearly $4 today. So trading above its 200-day moving average. Let's go ahead and take a look here at DeFi Llama. I'm going to type in UNI. We're going to take a look at the Uniswap protocol. Okay, so $3 billion TVL. Not bad. Let's scroll down here and let's see, where's that income statement? Here it is. So earnings in Q3, 3.85 million. Earnings in Q2, 13.45 million. And let's see here. So what is it exactly that I'm looking for?
Right underneath it, token holder net income. He's basically asking if those numbers look right.
Well, I'm not certain that token holders. Okay, so let's read this. So I'm just hovering my cursor over token holder net income. I'm just going to read this out so that we can all get a little bit of information here together. So Uniswap V2 from 28 December 2025, it's 17% of fees on Ethereum shared to buy back and burn Uni. It was 0% before. So that's from December 2025. Okay, so that makes sense, right? So you can see here, Q1 2026, 10.17 million in token holder net income. Okay, that makes sense because that's the fee switch, right? Now from the 8th of March 2026, 17% of fees on these chains, Optimism, Arbitrum, Base, Zora, X-layer chains are shared to buy back and burn Uni. Okay, and then for Uni, that was all for Uniswap V2. Now for Uniswap V3, this is concentrated liquidity provision. From the 28th of December 2025, a portion of fees collected to buy back and burn Uni from Ethereum. So from the 8th of March, that's when the fee switch I think really took effect. From the 8th of March 2026 on Optimism, Arbitrum, Base, I don't know what WC is, Zora, X-layer. So that's a portion of fees are used to buy back and burn Uni. But those fees are being taken from LPs. So if you're an LP, suddenly you're earning between, I think it's 20 and 30% less, taken right off the top. So you're already not statistically positive when you provide a full range or concentrated liquidity, but now you earn between 20 and 30% less. So make it make sense, man. It doesn't make sense to provide liquidity on Uniswap anymore. Now, if you take a look at from the 2nd of June, 2026, those fees on Polygon, BNB chain, and Celo, and then from the 27th of July, which was just 2 days ago, that's on Robinhood Uniswap V4. So that fee switch was enabled from the 27th of July and is tracked on Uniswap V3 and Uniswap V4 on the Robinhood chain. So a lot of volumes on the Robinhood chain on Uniswap V3 and V4. But if you're an LP, you earn now 20 or 30% less. So I think that Uni fee switch is going to be a huge net positive for Aerodrome, because Aerodrome, if you don't stake your LP, then you get paid in the underlying tokens. Yes, you get paid 10% less, but 10% less is a smaller figure than between 20 and 30% less on Uniswap. So,
well, and like I keep saying, is you can always take it in Arrow and then just swap it into the USDC or whatever else you want to do, and get that 10%. It just you just have to add an extra step.
well, it's not as simple as that, in my opinion, though, Mike, because Arrow is extremely volatile. So if you're earning Arrow,
I mean, it can work for or against you,
right?
But,
So here's the Arrow token. So if you're earning your fees in Arrow, and Arrow is down like it is today, 5.26% on the session, then whatever fees you earned, all of a sudden you have 5% less in stables.
That's still only 5% less instead of 10%.
True. Yeah. So I mean, pick your poison, right?
Yeah.
But
no. I'm just saying that there's options. That's all I'm pointing out.
Right. Yeah. So you're right. You're absolutely right. So where are LPs going to go? Where are they going to go? Because if you all of a sudden know that providing liquidity on Uniswap is a losing game, well, okay, maybe you migrate over to Aerodrome, or maybe you migrate to a Solana DEX. Maybe something like Orca. If you migrate, is it orca.so, I believe? So if you migrate to Orca, well, then hey, you know what? You don't have to worry about 20 or 30% of your fees being taken off the top like you do on Uniswap. You also don't have to worry about getting paid in a highly volatile token like Arrow, like you would on Aerodrome. And as long as you are very, very good at finding the right pools to provide liquidity in, then you could make money providing liquidity over here on Orca, a Solana DEX, or you could hop on over to Meteora, another high quality Solana DEX. So it really just depends on how good you are at determining which pools to provide liquidity in. And you've also got to really understand how liquidity provision works. So yeah, man, risks everywhere you go. And so Crypto Stevo is saying, but those fees are burned. So isn't that good for everyone? Well, it's good for you if you're a Uni token holder, but it's not good for you if you're an LP on Uniswap. Because if you're an LP on Uniswap and suddenly you're earning between 20 and 30% less in fees, that's like most of your profit, man. So it's not
a lot of people think like David, or they're educated on liquidity provision in LPs, and they start moving over to Meteora or one of those, then the fees go down. And if the fees go down, then it kind of the whole thing unravels to where if the fees go down, there isn't as much Uni being bought back and burned, and it's like this death spiral.
So honestly, when you're providing concentrated liquidity, and I know that a lot of people aren't going to like this, but one of the only ways that you can really get to profitability is if there is a ton of volume. And the pools in which there is a ton of volume tend to be these meme coin pools. And so where do you see the meme coins with the most volume? You see that on Solana. Solana continues to be kind of a casino for meme coins. We see Pump.Fun generating, 7 figures a week. I think it's like $7 million a week. And so, what I see is a lot of people will throw up on X these charts of protocols that generate a ton of revenue, but they obviously haven't gone through our deep dives in the Intel library. Because if you had gone through the deep dives in the Intel library, let's say on Pump.Fun, you would know that value accrual model for the Pump token is completely broken. But people don't know that. So they say, oh, they generate revenues and some of that's used to buy back the token. Yeah, but not really. You've got to dig into that deep dive research at the Node.pro in the Intel library. But if I was going to provide concentrated liquidity for a token pair, it would likely be Ansem, but I wouldn't pair it with USDC. This is an impermanent loss factor if you pair with it's an impermanent loss factor if you pair it with a stablecoin. I would prefer to pair with Sol. But if I'm taking a look at Bonk paired with Sol, this yield to TVL, 9.30%, if Bonk and or Sol are going to move by greater than 9.30%, it's tough. And this is over a 30-day period. Let's zoom in to a 24-hour period. Now, all of a sudden, none of these pools make sense, because if my yield is in Ansem USDC, let's call it 1.3%. If my yield is roughly 1.3%, but that Ansem token is more volatile, meaning it moves by more than 1.3% over a 24-hour period, you're not going to make money. So, like, especially not compared to holding. So, yeah, man, these liquidity provision most of the time is a losing game. And yeah, Paulo in the chat saying 90% of CLPs are bad, especially during a bear market. Very hard to be profitable, even with a hedge. I would say that if you hedge, all you're doing is forcing yourself to realize impermanent loss on the way up. So,
yeah, it just hasn't been done the right way.
Oh yeah, exactly.
It's like, it's like socialism. It just hasn't been done the right way yet.
Right. Just give me all of the power and then I'll do it the right way. It's like, no, man, that's not how this works. That's not how humans work.
Send me your liquidity. I'll use it properly in the liquidity pool.
Yeah, human's gonna human, man. So, all right. So here's the income statement for Morpho. Yuck. Like, these earnings negative, like, make this make sense. So, man, that doesn't look good. It looks like cost of revenue is ridiculously high. Wow, why is that? So it looks like for Morpho Blue, total interests are distributed to suppliers and lenders, plus liquidation bonuses to liquidators. For Morpho Midnight, that's that new fixed rate borrowing protocol that Morpho launched. Interest is distributed to lenders. So total borrow interest minus the protocol settlement and continuous fees. So it looks like Morpho is incentivizing people to provide capital to their vaults. This, maybe I'm missing something on this interest or on this income statement. I could be missing something here. Maybe I'm not reading this correctly. But I also see token holder net income, big old goose egg there on the bottom. You see this down here, Mike? Token holder net income for Morpho, goose egg.
Oh yeah,
0.
There's no no value capture for the Morpho token at all.
So if we bring it on back to that Morpho token, Morpho USDT,
even on their platform, there's no staking for it. As bullish as I am on Morpho, like the small bag that I hold of it is purely, I'm betting on a speculative pump. That if the market starts moving and these institutions are using the vaults and all that stuff, and it gets a lot of mind share, that it gets a pump, and I'm going to sell into that pump.
Yeah, that's like a meme coin, Yeah. So we always look for the trifecta.
But if I'm going to do a meme coin play, I'm going to do one based off of something with at least some fundamentals behind it, rather than just like a cartoon monkey or something.
I don't know, man. I kind of like the cartoon monkeys because at least you can capture 100 bagger out of those things. Like, what exactly do you expect out of Morpho?
I'm just looking for a 10x.
Okay. Well, okay. All right. So let's.
It may or may not happen, but all this is a gamble. But the majority of my bags are in what I feel is and it's backed by some solid data. But projects like Canton, that have solid adoption. The value capture is great for the token. Again, it is inflationary currently, but if it plays out, where the adoption keeps up and it flips deflationary, that I see a lot more potential there than I do in 95% or more of the crypto projects out there. So, to an extent, all of these are speculative assets, but and especially a lot of these that have massively, what I feel, massively overvalued market caps. Where they have in the billions of dollars of as far as market cap, and they generate little to no fees or revenue. So think of the market cap as basically the valuation for the business. The math doesn't math.
Yeah, the math has got to math. So speaking of the math not mathing, I'm curious to start off our deep dives today, Mike, with Eigenlayer, because there's so much stuff built on top of this. And I'm going to go ahead and share this into the source room so that anyone who is in our source room, this is the Node.pro, this is our community, and we got a bunch of people in here now, man. So Eigen Cloud, we're going to take a look at Eigen Layer right now. So if you want to follow along, hop on into the Node.pro, click on into the community, or jump into the Intel library, and then we're going to start off here with Eigen Layer. Okay. Before we do this real quick, I just want to take a look at that Eigen token, Eigen USDT. All right. Ouch. Ick. Yuck. This is not nice. This is very not. This is bad, man. Like, this thing just looks like doo-doo. And, trading below its 200-day moving average, basically down only. So let's learn a little bit here about EigenLayer.
Artificial intelligence models require massive processing power to operate. But to safely transition these models from basic conversational tools into autonomous agents that control financial assets, they require strict execution provenance. There is a direct collision between this high-speed computational load and the rigid decentralized security constraints of Web3. Standard Web 2 infrastructure, like AWS EC2, cannot bridge this gap. Developers and end users are dependent on centralized providers to execute model weights honestly and secure private keys transparently. Pure smart contract networks like Ethereum eliminate that centralized dependency, but they are limited by low computational capacity. Running complex AI reasoning directly on-chain is impractical due to rigid constraints and gas overheads. EigenCloud addresses this bottleneck by transitioning from a restaking protocol into a verifiable cloud platform. It bridges off-chain hardware execution with crypto economic security. Scaling the machine economy requires moving heavy computational processing off-chain, while anchoring penalty mechanisms strictly on-chain. The foundation of this platform is EigenCompute. It operates as an off-chain execution layer, where developers write application logic in standard Web 2 programming languages and package the software into containerized Docker images. This diagram illustrates the execution architecture. The Docker container runs inside an Intel TDX enclave. It extracts a unique cryptographic hash, the Docker digest, and commits it to an Ethereum smart contract. By isolating execution in encrypted memory, the hardware generates a cryptographic remote attestation, proving the code is unmanipulated. EVM private keys are generated inside the secure enclave, inaccessible to external operators. Operating these autonomous agents generate high-frequency telemetry logs and state synchronizations. Processing this volume of data cannot economically fit on the EVM. EigenCloud delegates this storage requirement to EigenDA, a specialized data availability primitive designed to operate alongside the off-chain compute enclaves. EigenDA uses erasure coding and KZG polynomial commitments to disperse data across node operators. This ensures that large state files remain available for execution auditing without incurring Ethereum storage costs. Combining secure hardware enclaves with KZG data commitments gives developers the performance of serverless Web 2 containers while preserving the cryptographic execution proofs of Web 3. With the infrastructure established, EigenCloud layers on the entities operating upon it. The agent kit
This is the important part, the layering of entities on top.
Framework grants AI agents native digital agency from the moment they are deployed. Agents launched via AgentKit are provisioned with independent EVM wallets, dedicated email endpoints, and sovereign public web profiles. This schematic breaks down an agent's logic core. Soul.md dictates personality, Process.toml handles sequencing, and Constitution.md defines operational boundaries. Over time, the agent autonomously updates its Soul and Process files. However, the agent cannot modify its own constitution. These operational boundaries, such as maximum transaction sizes, remain strictly fixed unless the human creator intervenes. To power the cognitive decisions constrained by these rules, the framework relies on EigenAI. Traditional AI integrations rely on opaque, black box model API responses. EigenAI replaces this with deterministic inference mechanics tailored for open-source large language models.
That's good.
The protocol generates cryptographic proofs detailing the exact model weights, system prompts, and context parameters utilized during a specific inference cycle. Securing cognitive boundary rules via AgentKit and the reasoning engine via EigenAI ensures an agent's logic is fully audited before executing binding financial transactions. Delegating execution off-chain introduces a security dilemma. How do you penalize a decentralized node if it violates its policy contract or produces fraudulent AI output? First, we isolate deterministic mathematical errors, known as objective faults. A common example is an operator node double signing a block or signing conflicting state roots. This split-screen flowchart shows how the protocol handles enforcement. On the left side, an automated smart contract detects a mathematical error and burns the operator's restaked ETH collateral. These objective faults are resolved entirely on-chain. On the right side, we encounter intersubjective faults. If an AI agent hallucinates data, human observers can identify it, but EVM math cannot. Relying on standard contracts to slash subjective outputs exposes the protocol to bugs. EigenCloud resolves this through slashing by forking. A challenger posts an EIGN bund, causing the staked collateral to fork into canonical and slashed branches. Over a 24-day window, the market adopts the honest token fork. Splitting enforcement between objective Ethereum math and intersubjective social consensus with B-Eigen allows EigenCloud to penalize subjective AI failures without compromising smart contract logic. The operational flow of capital requires a system capable of managing standard user billing over decentralized hardware. Developers and autonomous agents do not pay for operational compute runtime using volatile EIGN tokens. Instead, operational billing is settled in on-chain USDC compute credits. Using the X402 open standard, an HTTP 402 payment required code triggers an agent's embedded wallet to execute an instant USDC microtransaction over Layer 2. This allows agents to clear sub-cent stablecoin transfers for inference calls or data storage commits within a single request-response cycle. This introduces a tokenomics paradox. If operational billing is denominated in USDC to cover physical hardware and API gateways, how does EIGEN capture economic value?
Right, so this is about the Eigen value capture model.
This diagram details the AVS security fee pass-through. Third-party applications deposit security rewards into a smart contract, which splits the funds.
Okay, so we need to know what is AVS. So just real quick before we continue, I want to just look up, give me the depth, because that's the important part of Eigen. So what we've been looking at so far is about Eigen Cloud and Eigen AI agents and the SDK. But give me the definition of AVS in the context of Eigen layer, because AVS it's like you stake your ETH, and then AVS uses that staked ETH to validate other applications built on top of Eigen. So in the context of Eigen layer, AVS is an actively validated service. So it's any decentralized system or protocol that requires its own distributed validation mechanism to run, but it chooses to borrow Ethereum's economic security via restaking instead of bootstrapping its own native token network from scratch. So AVS is a service built on top of EigenLayer that rents security from Ethereum stakers. So that simply means that Ethereum that is staked can be used to secure multiple protocols. So let's go ahead and bring it on back to
Operators
this.
configure custom fee margins, typically 10%, to cover hardware expenses. The remaining 90% is compiled by off-chain updaters into a consolidated Merkle distribution route. This route is submitted on-chain for stakers to claim their accrued yields. EIGEN accrues value strictly through security collateralization and AVS reward pass-throughs. This insulates the autonomous agent's operational overhead from token market volatility. This interconnected architecture functions as a unified engine for the machine economy. An agent queries a large language model. An Intel TDX enclave computes the logic in isolated memory. The X402 protocol instantly clears the USDC micropayment. Finally, the enclave writes an immutable cryptographic attestation directly to Ethereum. This operational loop transitioned Egan from a generalized Ethereum restaking asset into a specialized intersubjective work token. By merging hardware attestations, decentralized data scaling, and dual-tiered economic enforcement, Egan Cloud provides the verifiable infrastructure necessary for AI to transition from conversational tools into financially sovereign economic actors.
So that's really interesting. Unfortunately, it didn't tell us a whole lot about Eigen, the token, and its value capture or lack thereof. It also didn't tell us a whole lot about what AVS actually is.
I'll
So,
be right.
Sure. So AVS and the value capture for the Eigen token, those are the two things that I really want to take a look at some point in the future here. So I think it might make sense for us to run additional deep dive research on Eigen Cloud. Well, maybe not on Eigen Cloud. So, Eigen Cloud, I think, is competing with a whole lot of other services for that same vertical. I'm more interested to learn about AVS. That's the thing that I want to learn more about. So I'm going to scroll down here and take a look at the source documentation. And I want to look at the actual cited sources themselves. Okay, so this is all about Eigen Cloud. So, maybe rather than taking a look at Eigen Cloud in the future, we can take a look at Eigen Layer and AVS. So let's see here. What is Eigen Layer? Let me see if I can open this up. Awesome. What is Eigen Layer? And this is from 2024. So Eigen Layer has been around for a while here. So I want to just scroll through this. Eigen Layer is an Ethereum-built protocol that supports the restaking of ETH on the blockchain's consensus layer. Through Eigen Layer smart contracts, those who stake ETH can provide crypto economic security to other applications across the network. So that's AVS. This is the important thing to know about Eigen Layer, is that it's a restaking protocol that allows you to provide crypto economic security to other applications across the Ethereum network. With Eigen Layer, Ethereum security is no longer fragmented across modules, but it is aggregated instead. So that improves security for dApps that use Eigen Layer modules. So Eigen Layer addresses some of that trust, some of the trust and innovation challenges faced on Ethereum. So that allows for faster development and deployment of dApps. Because if you don't have to bootstrap your own security, you can just borrow it using AVS, speeds up the process of launching your dApp. So TLDR, too long didn't read, it is definitely an innovative platform. So the security of Ethereum is transformed by Eigen Layer through the ability to restake staked ETH. So you stake your ETH and then you restake that ETH. And then that restaked ETH is used through AVS to provide security to other dApps. So it solves this fragmented trust. It addresses the slow progress and lack of confidence among some in Ethereum caused by divided trust. Enhances security by enhancing the safety of dApps and bridges, market-based governance. So what we might think about doing here, Mike, is running some deep dive research on Eigen Layer AVS and the value capture model for the Eigen token, because it looks like that deep dive research was about Eigen Cloud. And Eigen Cloud looks super interesting. Like if we take a look at the slide deck here, the Eigen Cloud is definitely an interesting piece of kit, an interesting product, but it told us nothing about AVS and the Eigen token itself. So I would be curious to take a look at that at some point in the future. All right, so that was a little bit about Eigen Cloud. That's Eigen Cloud 2026. Let's go ahead and take a look at Pyth. So I'm going to share this to the source room. We're going to talk here about Pyth now. So Pyth, or Pith, not quite sure how to pronounce this thing, but I think that this is like an Oracle provider. So we've got to begin by taking a look at the price performance of the Pith or Pyth token, which has been, the performance of Pith has been piss poor. So yeah, man, this is not good. So let me just go ahead and remove all of these drawn objects here, and let's just see what we see. So down only. Down only and trading below its 200-day moving average is Pyth. Let's go ahead and bring it on back. Let's learn about Pyth.
Traditional Web3 Oracle networks operate on a closed-loop economic model. They subsidize security by inflating their native supply to pay data providers, a cycle that requires constant external capital to prevent the token's purchasing power from eroding. In contrast, legacy financial data vendors like Bloomberg and Refinitiv operate outside of these tokenomics. They control a $50 billion global market by charging rigid, fiat-based subscription fees to institutions requiring reliable market data. This diagram illustrates the strategy behind the Pyth network's 2026 transition. The protocol is executing a dual migration, attempting to bridge the gap between inflationary Web3 infrastructure and the revenue-driven models of traditional enterprise data vendors. The first phase of this migration is a technical teardown. Pyth is deprecating its native application chain in favor of an ultra-low latency off-chain execution environment. The second phase is a total economic restructuring. The network is stripping away its token emission subsidies and replacing them with a corporate-style revenue and open market buyback model. But executing this pivot introduces a strict mathematical collision. Pyth's attempt to unbundle traditional financial data is running head-on into a massive pre-programmed supply cliff in May 2026, where 2.1 billion locked tokens will enter circulation. The protocol's long-term survival now hinges on a single metric, whether its newly established enter supply shock. To understand the revenue engine, we have to look at the latency problem. Traditional push oracles operate by periodically writing price data directly to a blockchain. This creates significant latency windows and exacts high gas costs, leaving platforms exposed to front-running and latency arbitrage. This timeline charts oracle speed. Pyth pioneered poll oracles, streaming data off-chain to PythNet, dropping latency to 400 milliseconds. However, high-frequency derivatives engines demand data in the extreme 1 millisecond zone. Reaching that threshold required a structural teardown. Through governance mandate OP-PIP 100, the DAO authorized the complete sunsetting of PythNet, deliberately killing the network's foundational Solana-based app chain. In its place, the protocol deployed Pyth Laser. Built on Rust and TypeScript, Laser is an ultra-low latency infrastructure layer that entirely bypasses the traditional consensus bottlenecks of a dedicated app chain validator set. Laser introduces customizable delivery channels. Developers can map their data needs to standard 50 millisecond or 200 millisecond feeds, or access a 1 millisecond ultra-high-frequency channel for speed-sensitive applications. By stripping away the app chain overhead, the network also rapidly expanded its operational bandwidth, scaling its asset coverage to support over 3,000 live feeds. Achieving sub-millisecond execution was the technical prerequisite the network needed to package decentralized data and sell it to traditional financial institutions. To monetize that speed, the network launched Pyth Pro. This enterprise distribution layer repackages layers sub-millisecond data into standard API frameworks, designed specifically for hedge funds, banks, and algorithmic trading desks. The commercial model relies on flat subscription tiers. Institutional clients pay $10,000 per month for cross-asset access, while professional crypto trading venues pay $5,000 per month for specialized digital asset feeds. This infrastructure secured immediate validation from traditional finance. Legacy market participants like Tradeweb and Fenix integrated their proprietary fixed income pricing directly into the network. The U.S. Department of Commerce selected Pyth to publish its official federal economic statistics on-chain, establishing a direct regulatory and operational link between federal institutions and decentralized networks.
Now, why didn't they choose Chainlink? Maybe Chainlink is too slow? I don't know.
As enterprise adoption scaled, Pyth evaluated its original security model, Oracle Integrity Staking, or OIS. Under OIS, the protocol paid inflationary token rewards to publishers in exchange for honest data reporting. This equation represents the exact moment Pyth abandoned inflationary security. Through proposal OPPIP 103, the DAO deliberately set the OIS reward emission rate parameter to absolute zero, shutting off the token subsidies. Continuing to emit tokens on PythNet, an app chain already scheduled for deprecation, would have forced the protocol's smart contracts to calculate phantom reward obligations, causing eventual state corruption. More importantly, the data proved the subsidies were obsolete. Throughout the entire lifetime of OIS, data publishers maintained perfect feed integrity. zero slashing events occurred, demonstrating that institutional providers operated honestly without requiring a constant stream of token payouts. By turning off the emissions, Pyth proved that entities like SIBO and Jane Street prioritize their corporate reputation and API distribution networks over inflationary token farming. Pyth Pro's fiat revenue splits: 40% funds Doro Labs infrastructure, while 60% routes to the DAO treasury. 33% of that balance is deployed onto Jupiter Exchange to systematically buy Pyth tokens off the open market.
Okay, so 60% goes to the treasury, of which 1/3 is used to buy back and burn the token. So what is 1/3 of 60%? 20%. So 1/5 of that revenue is used to buy back and burn the token, unlike many of the other models that we see where it's maybe 100%, let's say. So a small portion is used to buy back and burn the token. And I wonder what does Doro stand for? DOURO. Because a lot of these companies like to use Greek mythology or Roman gods or stuff like that to name themselves. I wonder what Doro stands for.
Orders route through a Solana multi-signature wallet, capped at $25,000 to prevent slippage. Purchased tokens aren't burned. They enter a strategic reserve, pulling assets out of circulation to back the network's balance sheet. This differs entirely from standard decentralized finance models, where protocols typically drain their treasuries to distribute raw yield or stablecoins directly to individual stakers. By utilizing corporate-style open market buybacks, the network avoids creating taxable, yield-bearing securities. Instead, it translates enterprise fiat subscriptions into continuous, predictable spot buying pressure on its own asset.
Right, but obviously it's not anywhere near to enough.
But the efficiency of this revenue engine is currently overshadowed by the protocol's hard supply metrics.
Right.
Entering mid-2026, only 57.5% of Pyth's 10 billion maximum token supply is actively circulating in the market. The remaining locked supply creates a massive overhang, culminating in the 30-month unlock cliff scheduled for May 2026. This date triggers one of the largest single-day liquidity events in the Oracle sector. These restricted tokens originate from 3 distinct allocations: ecosystem growth grants, early publisher reward batches, and private sale tranches reserved for venture backers.
Okay, so Doro means river of gold.
Well, DORO means river of gold, like DEOURO is Spanish for river of gold.
Right, so de oro, but in folk etymology, I guess a legend claims that Douro comes from the Portuguese do ouro, of gold, right? Yeah. I'm reading the same thing. Kind of interesting.
Over 2.1 billion tokens unlock simultaneously. This single event expands.
So obviously this means river of gold for the VCs who got in early, not river of gold for anyone who's holding Pyth.
The network's total circulating float by roughly 36% overnight. When we compare the protocol's real economic demand against this incoming supply, the scale of the shock becomes clear. On the left is the annual buyback demand generated by the protocol's revenue. On the right is the sheer volume of the May cliff.
Oh, dude, look at that. So if this is the annual buyback demand in token terms, but in one day, you've got this net supply overhead. I mean, yeah, the math doesn't math here for anyone holding Pyth.
At a $1 million annualized run rate, the programmatic buyback engine absorbs approximately 1.5% of the tokens entering circulation. This leaves a net supply overhead of over 2.1 billion tokens, exposing the market to significant downward volatility regardless of the protocol's organic growth.
Yeah, seriously.
Following the May 2026 cliff, Pyth's spot price is dictated by macro liquidity as expanding float outpaces institutional revenue.
Yeah.
Projecting into 2027, the supply schedule flattens. Long-term viability relies on executing TradFi unbundling arbitrage. Legacy financial market terminals and the data they provide cost institutions anywhere from $24,000 to $500,000 per seat every single year. Pyth is undercutting this entire industry by offering sub-millisecond cross-asset data feeds via API for roughly $120,000 annually.
Right, but here's a question. Okay, great product, providing something extremely useful. Why do they need a token? Like, what's the point of the token? Like this could have just been like a business and they could be a successful business, but what's the point of the token?
Providing equivalent institutional data at a fraction of the historical cost. If Pyth Pro scales its operations to capture just 0.5% of the $50 billion global enterprise data market, the network would generate $250 million in annual recurring revenue. Applying the DAO's 33% treasury rule to that volume yields $49.5 million in continuous programmatic spot buying pressure, sweeping the secondary markets every year.
That's a big if. That's a big if.
The protocol now operates as a balance sheet-backed enterprise utility. Its long-term valuation is tied to the conversion of traditional financial subscriptions into raw on-chain demand, rather than the mechanics of inflationary token emissions.
Yeah, but I mean, so far, it's still something that's just getting dumped every single day. So it looks like this is a very high-speed data provider. And that's great, especially if you're running a prop fund or a hedge fund. But
what does that mean to the token holder?
Right. If you're holding Pyth, you're just getting dumped on. There's no river of gold for you. So this is Pyth, man. Down only and let's just measure this from the all-time highs of $1.16 down to the lows. That's negative 97.5%. Ouch. And, why would this ever recover? Because just because it's down 97% does not make it a good buy. Just because something is down a lot, that doesn't make it cheap. Maybe it's still expensive at 4 cents, So, yikes. But we get the Fed. We get the Fed in 23 minutes. So I just want to
I'm finding it harder and harder to find projects that I even want to put liquidity into, man.
Me too. There are very few. And even the good projects have problems like Hype. Like this is, I think, right now, a great protocol with a ton of regulatory risk, though. This is an American perp stacks. The moment that we have that Clarity Act or some SEC rules, I think that this perp stacks, because Mike, maybe you can look up.
Already, to use Hyperliquid, you have to use a freaking VPN.
Right, but that could be eliminated as a way to access Hyperliquid for U.S. citizens.
Yeah.
So here, tell me about Hyperliquid stars and accessing the front end and the API. So I was reading something yesterday about stars, Hyperliquid stars. I don't know exactly what that is. I think it's something built into the smart contracts, like something they have just started to build into the smart contracts. Okay, got it. So here's a breakdown of Hyperliquid stars. And I just want to go ahead and hide this so we can take a look at this together. So there's the chart of Hype, the Hype token, right? This is the chart of Hype. And it's just kind of compressing within this pattern. Now, stars, Hyperliquid stars are how the front-end ecosystem operates. And so here we go. Stars is an access control and permissioning feature introduced on the Hyperliquid testnet. So what does that tell you? If this is an access control and permissioning feature introduced on the testnet, then maybe this gets rolled out on mainnet pretty soon. So it provides an optional address whitelisting system for DEXs deployed on Hyperliquid, particularly under the HIP-3 DEX framework. So the key mechanics of stars are whitelist limits. So a DEX or pool deployer can restrict who can open or increase positions. It supports a whitelist of up to 10,000 wallet addresses. It also implements position safeguards, so that's reduce-only mode. So if an address is not on the whitelist, it is not completely blocked, but non-whitelisted users can still deposit funds and execute reduce-only orders to close out or trim existing open positions. This prevents users from being trapped in positions if whitelist statuses change. Okay, so the primary use cases for this, regulated in RWA assets. It enables tokenized equities, or RWAs, to require identity verification or geographic compliance before opening positions. So think about that. You might not be able to ever trade in certain markets on Hyperliquid if your address is not whitelisted. In order to get on the whitelist, you probably got to pass KYC or something. It looks like it's also for private funds and trading clubs. So like a DAO or an institutional fund or maybe a private trading group could run gated high-performance order book markets. Okay, that's pretty cool. And then alpha testing and soft launches. So developers can open early trading exclusively to designated market makers or community testers. So it looks like for accessing the front end, Hyperliquid is going to take a unique approach to user interfaces compared to typical centralized or decentralized exchanges. So there's a couple of options here. You've got option A. This is the native interface. You can access the protocol directly at the front end at app.hyperliquid.xyz. So you've got a wallet connection, or you can connect agents. And then option B is like the third-party front end or builder codes. And then, of course, you've got access via the APIs. But here's the API. But here's the problem, though. Like, if they implement stars on all HIP DEX markets, then unless you pass KYC and or get whitelisted in some way, you're locked out. And so it wouldn't matter if you...
all the users on Coinbase don't mind KYC. All the users on Robinhood don't mind KYC.
Those are centralized exchanges. Hyperliquid is supposed to be a DEX.
Well, it's supposed to be a DEX, but from a pure use standpoint and fees, fee generation standpoint, Crypto Stevo has a point. There's plenty of exchanges out there that have KYC, AML, all that regulatory stuff, and they do just fine.
Do they?
Yeah.
I don't know. Let's take a look at Coinbase's stock. Coin.
Look at Robinhood.
Yeah, so here's Coin. This is Coinbase stock. And, from its all-time highs down, what is that? Let me go ahead and remove this drawn object right here so we can see that a little bit more clearly. From the all-time high to the trough a couple of weeks ago, it's down 67%. And here is Robinhood.
Check out the stock market. To buy and sell stocks, you got a KYC and AML.
Yeah,
it's just, philosophically, you can, not like it, but it's, there's plenty of successful companies out there that, have to operate under the regulatory, constraints.
Yeah, well, that's against the ethos of crypto and Web3.
Ethos in one hand and profit in the other.
Yeah,
which one, do you want a profit, or it's we can sit on a soapbox and pound our fist, or we can profit.
Well, so that's exactly my point, though.
I'd rather sit on a soapbox and pound my fist with some money in my pocket than do it broke, because I can accomplish a lot more with money in my pocket than I can being broke and railing on about the system being broken.
Yeah, no, I hear you. And I don't entirely disagree. If and until there's a communist president and they start taking all of your money, regardless of how much you make.
Oh, yeah, I know. I'm not saying that I'm only going to operate, in that ecosystem, but if I can profit in that ecosystem and off ramp, my profits into decentralized, areas. Either buying gold and silver or using decentralized exchanges and things like that. Absolutely, it's like I'm not going to ignore or limit myself from being able to be profitable.
So here, check this out, Mike. This is interesting. So this is an X post, and this is gross income versus disposable income for German citizens, right? So even as you make more money in Germany, they are very, very good at stealing it from you.
Yep.
So, you're actually disincentivized from doing better when you live in a socialist, quasi-socialist. Dude, this is communism right here. This is bullshit.
Dude, look at. I'll bet you the chart for Americans doesn't look much better.
Well, I think it does. It looks a lot better, but it depends on how much you make. So, like, if you make in California, for example, I think you're probably better off if you make like $60K in California. You're probably better off quitting your job and going on welfare because, like, the amount of disposable income.
It's to be that's all Americans, because if you're inflation, the way that inflation's been going up and the cost of goods and services have been going up, they've been greatly outpacing any raises anybody might have gotten. So I would dare say that the U.S. doesn't look much better than this.
Yeah, well, I think it does look a lot better than this, but the point stands is that, like, if you're a trader on Hyperliquid or any so-called decentralized exchange, and then all of a sudden they implement KYC AML because, and here, let me just share my screen. So I really do want to take a look at yields because we're going to get the Fed in 15 minutes. But, if you're trading on a DEX, and all of a sudden, from one day to the next, they've got to implement KYC AML, and you get locked out. I don't see how that's going to be a net positive for Hype, the token, if all of a sudden a lot of those trading volumes go away.
Well, you're assuming that those trading volumes will go away.
I think that the majority of trading volumes come from Americans.
Oh, but if it's KYC AML and just those people KYC and AML, those fees aren't going to go anywhere.
Yeah, but why would you if you could just migrate to a true DEX like GMX?
It's just if people are using it, they like the UI, the UX, they like the deep liquidity. They're invested in there's a million reasons why they would stay. Then there's reasons why they would go. I'm just saying that simply, I'm not going to allow, my personal feelings on, self-sovereignty to, dictate how I invest, because, that's emotion, and I don't allow emotion in my investing.
Well, I agree with you. I agree with you on that point. But I also think about, okay, well, if you're, KYC AML'd, and all of a sudden there's a socialist president and capital gains taxes go from 15% to 50%, then it's like, ugh.
If you have a bank account, if you have any type of investment account, if you want to go get a loan, that's all, the way it is now. You have
that's the whole point of DeFi, is the parallel.
That.
Yeah.
I get that. But it's a nothing burger, really, because there's a very small subsection of the global population that even knows what decentralized finance is, let alone uses it. So it's just, if they have to KYC AML, and as people start getting onboarded, most of them won't even know that DeFi existed. If DeFi went away, let's just say in a dystopian world where the powers that be wiped out all of DeFi, most of the world doesn't even know it exists, and they're going to get onboarded onto crypto. Half of them, if not more, aren't even going to realize they're onboarded onto crypto, and they're just going to be like, "Oh yeah, got a KYC AML just like I do everything else."
You'll own nothing and be happy. Is that the takeaway?
I'm just saying that that's the reality. Is most people are going through life with blinders on, just trying to survive, or they're so engrossed in social media and everything that they have no clue. So it's just, there is a very, very, very small percentage of the population that even know what DeFi is, let alone care about the ethos of it.
Well, hopefully we're able to change that. Bitcoin fixes this. Yeah,
I hope. But we got to be real. Thinking of it, looking at it from that angle, am I wrong?
I think so. I want to think you're wrong.
You want to think that, but that's an emotion. But in the reality is that if you walk down the street and ask somebody to explain what or one, have they heard of DeFi? And
I know.
Two,
You're
you
right.
explain what DeFi is.
Yeah, they don't know. They look at me like I've got 3 heads. Yeah.
Yeah. It's like if I put
Like,
if I put a gun to my own head, was like, have you ever heard of DeFi? Chances are I'd be alive at the end of the day.
So let's take a look at yields real quick, because in 10 minutes we're going to get the Fed rate decision.
All right.
And so the Fed is stuck between a rock and a hard place here. Now, yields sitting at 4.650% on the 10-year, and this has pulled back over the last couple of sessions, but I mean, man, like this is starting to get elevated. And if we take a look at the 30-year, this is the 10-year. Now here's the 30-year. The 30-year is sitting at 5.117%. So I've got this level drawn in, but I'm going to go ahead and remove that. We've got a little bit of a double top forming here on the yield for 30-year bonds. Now, I think we need to also continue to track the Japanese 30-year because USD JPY at 163, like eventually they're going to have to intervene to support the yen if they haven't started doing so already. So what does that mean? Well, it could mean that the Bank of Japan is forced to sell treasuries. So if they're selling treasuries, the proceeds are denominated in dollars. They then take those dollars to buy yen. That would be a way to support the yen. Because if we take a look at USD JPY here sitting at 163, it's broken out. It's broken out above that long term. This is like a 35 or 40-year level of horizontal resistance that was broken to the upside. So the yen could run, I think, all the way up to like 200. That would mean significant weakening of the yen. So yeah, man, with Japanese yields on the 30-year up at 3.92%, and the Japanese 10-year, a lot of people have been saying that they think that could run to 4%. So that means all of those assets that have been purchased with borrowed yen get sold and repatriated. So yeah, that's not too good, but we're getting a little bit of a rally into the Fed decision here from Bitcoin and from ETH. So if we just take a look at this real quick, this is the hourly for BTC. I'm going to go ahead and make this so that we can all see this a little bit more clearly. So basically, we've been moving sideways for basically the last 2 weeks. So Bitcoin's been moving sideways for the last 2 weeks. You got the high up there at 67K, let's call it. We've got a low down here at 61,850. So yeah, it's going to be market moving, whatever Kevin Warsh does today in 7 minutes time. I think that you always end up getting a big move out of BTC on Fed days. And as of right now, we're just moving sideways. Here's Ethereum. Ethereum has actually been outperforming Bitcoin for much of the last couple of months here. So this is an hourly chart. And you can see we've got this level of support. And ETH has been holding this level of support on the way up. This is in US dollar terms. But ETH has also been outperforming BTC. So yeah, man, it's going to be really interesting to see what happens when the Fed makes its decision in a couple of minutes. Let's hop on over here to Fed Watch. We've got 6 minutes until the FOMC rate decision. And then immediately after that, we're going to get earnings from, looking for, what is the likelihood? So it's still loading here. So in just about 5 minutes, we're going to get that rate decision. And this is taking a little while to load. I wonder why that is. I'm waiting for Fed Watch to load. It's not showing me the likelihood of a hold or a hike. So maybe that's just because the FOMC meeting is about to start. There it is. Awesome. So there's still a 30% chance of a surprise hike in a couple of minutes here. So yeah, man, this is going to be exciting. We'll see how digital assets react to the Fed here. Now, when was the last Fed meeting? So I want to go back in time and I want to see, what was the reaction by Bitcoin and ETH to the last couple of Fed rate decisions. So what were the last 4 Fed, I'm going to say FOMC rate decision dates. What were the dates? Because then I can mark those on the chart, and then we can take a look and see how Bitcoin and ETH performed in the wake of those Fed decisions. So June 17th was the last FOMC rate decision. So I'm going to grab a vertical line, and I want to mark June 17th and April 29th. So June 17th was right here, and April 29th was right here. Okay, so this is ETH. So in the days following the April decision, ETH rallied and then gave it up. And in the days following the July decision, ETH moved slightly higher. Let's take a look at BTC. So July, was it July or June? It was June. So I made a mistake there. It was June 17th. June 17th. There we go. So, oh, wow. So in the days following the April decision, ETH rolled over. In the days following the June decision, ETH rolled over. Let's take a look at BTC. So June 17th and April 29th. So June 17th, BTC rolled over. And April 29th, right here, BTC rallied and then rolled over sharply. So that's the last two FOMC rate decisions. And we're going to get the announcement in a couple of minutes here. We're getting a rally into the announcement. You see that? ETH up, basically like up 20 points in the last couple of minutes. Bitcoin rallying a couple of 100 points in the last couple of minutes here. So this is going to be, this is going to definitely move. That's for sure. So what was the last one before that? March 18th. Let's mark off March 18th also. March 18th, right there. So after the March decision, Bitcoin pulled back. Let's take a look at ETH. After that March decision, March 18th, right there, ETH pulled back also. So after the March decision, ETH pulled back 19%. After the April decision, ETH pulled back 37%. After the June decision, ETH pulled back 18%. Let's take a look at Bitcoin. So after the March decision, Bitcoin pulled back 14%. After the April decision, from peak to trough, Bitcoin pulled back by 28%. And after the June decision, Bitcoin pulled back by 14%. So what is going to happen today? I'm going to go ahead and mark it right there. And for ETH, I'm going to go ahead and mark this also. So it looks like we're getting a little bit of a rally into the rate decision here. So 2 minutes, FOMC in 2 minutes. And the one before that was January 28th. So I just want to mark the January decision also. So January 28th was right here. Oh, wow. Wow. That's Jan 28th. Wow. So after the January decision, ETH pulled back by 42%. And Bitcoin, after that January 28th FOMC, Bitcoin pulled back by 34%. So over the last 4 FOMC decisions, Bitcoin and ETH have pulled back. There were brief rallies, it looks like, immediately following just the April decision, and maybe you could also say the June decision also. Man, well, we got 60 seconds. I'm going to go ahead and zoom into a 5-minute, and let's just watch this. So look at that on the 5-minute. Yeah, we got a nice rally out of BTC from the trough at 63,600 all the way up to 64,200. That's for BTC. And here's ETH. Oh, wow, rallying from 1887 all the way up to 1915. So we're getting a rally out of both Bitcoin and ETH into the FOMC decision here. Let's see what happens. We're going to have a move, no doubt about it. And any second now, it looks like we get that in 15 seconds. 15 seconds. Here we go. Let me zoom into the 1 minute. So here's the 1 minute chart for BTC. Let's see what we get in a couple of seconds here. Oh, there we go. That must have been it, right? So we got it just happened.
Oh,
Look at that.
oh.
There we go. Boom. 64,550. Wow. And ETH rallying 1927, 1925. So we're getting these big rallies on the 1 minute here. Are we going to get continuation? So here's BTC. BTC put in a high 64,650, and it looks like the S&P and the NASDAQ are rallying off of their lows. So yeah, man, wow, we're getting some big rallies here. And so how many points is this? It looks like the rally's about 1,000 points out of BTC from trough to peak. And for ETH, the rally is about 35 points or so. So Bitcoin and ETH, the majors, definitely enjoying this FOMC rate decision. And what did they do, Mike? Did they hold? Is that what they did, or did they raise? I think they must have held. There's no way that they hiked. No way, right? It must have been a hold on rates here. So I want to just find out what was the decision. So what was the FOMC rate decision today, just now? Let's see if Gemini is able to give me those data. Because usually you get a fake out. So whatever the initial reaction is, it ends up reversing course. Yeah, right. So what was
that's why I was joking, like, and it dumps.
Yeah. So the Fed. So the verdict from today's meeting: the Fed voted 9-3 to hold interest rates, to hold the rate of between 3.50 and 3.75%. So it kept rates unchanged. The vote was not unanimous. 3 members dissented, voting in favor of a 25 basis point rate hike. So 3 dissents. And look at that, we're getting more upside out of BTC. So the statement noted that economic activity expands at a solid pace with strong job gains and productivity growth. Policymakers emphasize that inflation remains elevated above their 2% target. And Fed Chair Kevin Warsh is holding his post-meeting press conference. So let's see if I can find a link. Give me a link to Fed Chair Warsh's press conference. This could be fun to watch, just taking a look here at BTC, rallied back up to the highs after the rate decision at 64,650. ETH also put in a higher high at 1935. So getting some decent rallies here out of Bitcoin and out of ETH. It looks like there is a Federal Reserve YouTube channel. There's a YouTube live stream.
Yeah,
so, wow.
Scotty's saying go to whitehouse.gov and you can probably find it. Don't do it. Don't do it. I'm joking.
No. So I found it.
Yeah, don't go to whitehouse.gov.
Okay. But I see. So this is the presser. The presser is going to be in 27 minutes. So getting a decent rally out of both Bitcoin and ETH after the FOMC held rates steady, did not hike. So I think I'm definitely going to be watching. I'm going to watch the Kevin Warsh presser. That'll be interesting.
Get some snacks, maybe a couple beers, just sit back and enjoy the show.
Yeah, we'll see. We'll see about all that. But after every FOMC rate decision of the past, year to date, there's been a dumpy dump. So just keep that in mind. But that's all I got, Mike.
So, we don't have another show today, but tomorrow, we have, of course, this show at 9 a.m. And then tomorrow evening, I'm actually talking to Drew and seeing if he wants to come on for the Red Pill, where we're going to talk about civil discourse, basically the kind of the death of civil discourse and the need to bring it back, to where, and those that don't know, it's basically where people that have differing opinions can get together, discuss, complex topics in a, unemotional, I mean, it can be emotional, but a respectful way, and present their case, data, facts, logic, and hopefully everybody that listens and everyone involved, comes away a little more knowledgeable. I'm going to talk to David. I think one of us, most likely David, will probably be on a game show with Crux of Crypto, where he has a panel of people and they just kind of debate different crypto topics. But I think I'm going to host the Red Pill with Paulo, Jeff, and maybe Drew and a couple other people, and we're going to watch it live and give our commentary. So,
We'll do it live.
We'll do it live. And so it should be pretty interesting. I think so. Join us for that.
Sweet, man.
Awesome. Well, we hope to see you all tomorrow. And until then, Veteran Crypto out.
Peace.